From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for Friday, the 22nd of November, and we're less than a week out to Thanksgiving. Besides Turkey Day, what else is happening in Milwaukee? Well, your Bucks are home tomorrow night with the Charlotte Hornets, and the Packers are home this Sunday with the 49ers for a late afternoon kickoff. Or how about pancakes with Santa Claus at New Berlin Eisenhower High School? That's Sunday morning. And speaking of the Pack, they have a Thanksgiving evening game in chilly Lambeau Field. The perfect team to join us in snowy Green Bay, the tank top wearing, flip-flop wearing Miami Dolphins. Thank you, schedule makers. Let's start with a heads up. Did you know that Manatee Awareness Month is this month? This is a public service announcement for our Florida listeners. Keep an eye out for those sea cows on the highway. I'm sorry, I may already have had too much eggnog. Ooh. Here's the latest news from South Carolina Medical Testing Facility. As of today, there are still 8 monkeys on the lam and running free from the compound. The staff is trying to lure them with peanut butter and jelly sandwiches. What, no bananas? So who's not rooting for the monkeys? The same animal compound lost 2 emus a couple of months ago, and they're still on the loose. And the emus are perfectly named. They're Thelma and Louise. Look for them in the next Liberty Mutual commercial. And finally, Georgia police arrested the mother of an 11-year-old boy who was walking to the store alone. And the store is less than a mile from his house. Well, Mom got charged with endangerment and neglect. Really? My mom would still be in jail. On the podcast today, we have Art Rothschild, Steve Giles, Joel Driesing, and wrapping up the week, here's Kyle Tetting.
Well, thanks, Max. A good week overall. The NASDAQ up 1.7% this week, up 324 points, closing at 1904. The S&P 500 up 99 points this week. That's 1.7%, closing at 5969. And the Dow Jones Industrial Average added 2%, 852 points on the week after adding 426 on Friday, finishing the week at 44,297 for the year. NASDAQ up 27.3, the S&P close behind, up 26.5%, and the Dow Jones Industrial Average still robust, 19.2%, all including dividends. You know, Art, another good week in the books here, but it feels like maybe we've kind of fallen back to normal here a bit after some of the post-election hype, some of the post-election volatility. It felt at least a little more normal than what we had seen the last couple of weeks.
Yeah, my feelings exactly. This is the way it should be if we don't know exactly where we're going over any short period of time. Over long periods of time, the stock market always goes higher. Elections cause volatility because we don't know how they're going to turn out. After they happen, we know who's in power. We don't know what they're going to do. The rally we had right after the election, incident to the thought that we're going to have lower taxes and less regulation, tremendous. But that high wore off. The end of earnings season is another thing. This week there was a lot of anticipation for NVIDIA's earnings, and people were driving the stock up in anticipation of some tremendous report, which didn't happen. It was just kind of another great report. So the stock tailed off a little bit, still a popular stock. And as you mentioned in our lead up to the show, or in your write up for the show, Target, disappointing, profits. So the stock market is acting very rationally, driving up the growers and driving down the slackers. So yeah, it's a normal day, normal week, on Wall Street.
Well, I think it's also worth pointing out, Art, that we've got a 10-year Treasury at 4.4% and an earnings yield on the 12-month forward outlook for the S&P at about 4.5%. Investors are right now just hedging their bets. I think they've got a foot in both camps.
Well, and of course, we're at the tail end of third quarter earnings season. 475 of 500 companies reported. You basically now know here's a reasonable expectation for full year. And so when we talk about that forward earnings yield, it's a much better guess as to maybe where we are late in the earnings season than it is early in the earnings season. And so I think, you're talking about a pretty reasonable expectation, a pretty clean comparison between that and the 10-year, but also now you're talking about a market that doesn't have those big earnings announcements to move it anymore, and so it almost gets set adrift. If long-term it's all about earnings and interest rates, well, we're more or less done with the earnings conversations for a couple of months now. We'll pick it up again mid-January. But all of a sudden now the Fed is in focus, and all of a sudden maybe some headlines on politicians are in focus. And so I think that has the recipe either to be a very calming thing when not a lot of those headlines are all that unique, or potentially be a bit unnerving when you start seeing some things that maybe cause a little more uncertainty.
You know, Kyle, I find it interesting at times like this to manage portfolios for clients because we have this juxtaposition between the Dow Jones setting an all-time high, closing today, right, at 44,297, with the desire for, one, investors to want to continue to pile into this rally, and two, recognizing that, man, we're at an all-time high. Shouldn't we be trimming some winners? What are you doing for clients these days, Kyle, to try to help juggle that juxtaposition?
You know, I think it's such a perfect question because not only do we have all of this opportunity and gains, we also have a time of year in which we got to navigate a lot of different needs, cash needs, capital gains distributions, desires for gifting. There are so many kind of moving pieces that I do think it is the perfect opportunity to sit down and go, okay, let's really map out what the next 6 months or a year looks like for you. Let's get through all of the uncertainty that early next year is undoubtedly going to bring, and let's really plan ahead for here's what we need to do for you. And so while I am very optimistic about long-term where we're headed, I think you'd be a fool to not look at the opportunities we've been provided and say, okay, maybe we do want to have a little more of a game plan for cash right now. Maybe we want to know that we've taken care of your required distributions in your giving for this year, and we're going to start to set aside, here's what we're thinking for next year. So, yeah, it's the perfect time of year to start to think through, hey, up 11, 12, 13% on my portfolio, up double that in the stock market. Great opportunities to take some from cash. And then, you know, I think the challenge that we face there, Art, is what do we do with money if it isn't going to risk right now? How do we kind of navigate, you know, our portfolios overall? I know you and I talk quite a bit about what the opportunity set is. How do you kind of view that right now?
So compartmentalization is one of my favorite terms to use with clients when it comes to this type of decision making. The older I get, the more I appreciate the stability of cash, the more I appreciate the benefits over the long haul of stocks, and the more I appreciate the fact that bonds provide a consistent source, you know, of income with some volatility, especially in 2022 when they had their worst year in history. I want to come back to the Fed, though, just for a minute. In the last quarter, you know, we were anticipating, you know, what is the Fed going to do? Of course, in September, they started to lower rates. They lowered rates again, you know, this month. And I think we can anticipate they're going to lower rates another 0.25% in December. And so I think we'll have some stability from the Fed. So that's not the same kind of impediment it was. We had the election. We didn't know who was going to be running things. Now we know who is going to be running things, but we don't know what they're going to be doing. So I'm sticking with relative stability. You know, right now for this quarter, let's hope it continues that way, absent any shocks. Coming back to this reorganization of portfolio, you know, subject, I totally agree with both you guys. What a great time to take some money, put it into money markets that are still paying quite well, higher than inflation, for money you might want to use for something or money you just don't want to be going up and down. Bonds, still like short-term bonds. I'm not sure what's going to happen with inflation long-term, depending on which policies come up next year. So I really like short-term bonds for their stability. And the stock market, as we were discussing earlier, is kind of a function of what types of stocks should we be adding to portfolios, or should we simply be broadly diversifying? We like growth stocks for long-term gains. We like value stocks because they're undervalued. Foreign stocks, a little more problematical because of changes being made to our policies here vis-a-vis tariffs, et cetera. And cash. I just absolutely, as an old guy, love cash. So if I'm going to take money off the table, I'm going to keep it short.
I've joked with clients the last few weeks that sometimes it feels like we're professional fence sitters, right? That
Absolutely.
You're not going to push us one way or another. And I think the reality is, and it gets back to conversations I've heard from behavioral economists like Daniel Kahneman over the years, there is this massive aversion to loss that can cause you to make poor decisions. And it speaks to, well, we have to prepare for even the things that we hope never happen with a plan for how are we going to navigate that when it does. And so I think part of the reason you sit on the fence sometimes and say, well, I like growth stocks here, but I also like value stocks here, or I like bonds here, but I also like cash here, is that the reality is there is uncertainty. Now, maybe more than in a long time, there's uncertainty. It doesn't mean we don't have opinions. I love where we're headed long term with the stock market, but I need that piece, that other piece of the portfolio that is a little bit safer, to be the piece that gets us to that future. And Steve, I know that's the balance that you talk to clients about all the time.
Kyle, it isn't any different than when you go through the buffet line for Thanksgiving. Everything in moderation. You want to leave room on your plate for a little bit of everything because it's all good, right? And, maybe leave a little bit more room for dessert. But the point here is when we build portfolios, you want to build them in such a way that no matter what happens, you're still going to look smart longer term. Have that money set aside, as Art points out, for your short-term cash needs. Anything that you think you're going to need spending-wise in the next 12 to 36 months probably shouldn't be in the market, right? Longer-term stocks. Stock money that is in the market is going to be something that you're not going to touch for 10 years plus, right? It's retirement. It's long-term growth. And whatever's in between that, moderation. Make sure you got good balance and diversification.
Joel, we got an interesting piece of economic data this week, the first sentiment survey post-election, seeming to point to the fact that maybe a certain portion of our country is starting to feel a little bit better about where things are.
It's no surprise. I mean, you've talked about this in past podcasts, even leading up to this. Whoever wins the election, their partisans are more optimistic about the outlook. And the same thing happened in reverse in 2020. So what happened was the University of Michigan did its monthly consumer sentiment survey, and those who identified as Republican, their optimism for the future of their personal finances and the economy shot up. 4 years ago, the Democrats, their optimism for their personal finances and the economy shot up. So, and these things, forgive the analogy, but it's almost like talking about the weather. Some of these sentiment surveys where you meet people on the street and you say, what do you think about the weather? How's the weather? And then you take the next step and you say, what's the forecast? Right? And they can be very close on what current conditions are because they can see that. But as far as the forecast, it's all over the place. And so this partisan issue more affects the forecast. And it's, unlike the weather, which most people can't do anything about, especially long term, as far as consumer sentiment, there's something that matters to the economy in that we know that that's sort of a predictor of people's optimism is behind their spending, and we know that consumer spending is important for our economy. So this does matter, but in the margins, it doesn't matter as much.
And maybe one good piece of news was that overall the number improved a bit. I think maybe the portion that felt bad, there were more of them that are starting to feel better than the portion that felt good, less of them starting to feel worse. And so it isn't that everybody feels better about what's out there. It's just the portion that felt worse now feels a little better than the other way around.
Yeah, and it's interesting because there's some economic research that shows that those who identify as Republicans are 2.5 times more intense about how they feel about the outlook than those who identify as Democrats. So in today's survey that came out, 29%, the sentiment went up for Republicans, and it went down 11% for Democrats.
I think we try to find things that might point towards where we're headed. Certainly, consumer sentiment is one of those that tells you, here's how consumers might feel about spending money, which isn't going to show up in earnings for another 3 or 6 months. The other we get is the survey of leading economic indicators, a little bit of a read on kind of how we feel about those parts of the economy going forward.
And there's more science to that. It's more than just asking people how they feel. So that's important. But yeah, the Conference Board does this leading economic indicators. They take mostly government data and look at how it's doing. And their finding this week was that for the month of November, that the indicators actually got worse. That looking back in the last 6 months, the indicators went down by 2.4%, and it went down, 2.2%, and in the preceding 6 months, it went down by 2%. So that's a little concerning. We have to see where that leads us. It's showing us that the economy is slowing, which we've been watching through all of these separate indicators that we've been looking at. But it's also not surprising because that's what the Fed was trying to do by raising interest rates since early 2022, and now they're starting to cut those because they sort of think, okay, we've slowed the economy enough.
And then we got some data on housing starts, building permits, existing home sales, all pointing to a housing market that continues to show some signs of challenge, but strength in other areas.
Challenge is the word I was looking for. Yeah, it's and the thing about that, we were talking a little bit about this before the show started, was housing supply. My understanding and memory is that the sweet spot for the number of months supply of housing that you want to have at the current sales rate is 6 months. It's been below that seemingly forever. And this last month, it moved up to 4.2%. So the National Association of Realtors says, hey, look, we're feeling more optimistic because housing supply is going up, but it's still, in comparison to the sales rate, it's not keeping up with demand.
And of course, the reason why that's so important is because if you're looking to move, you need somewhere to move. You need inventory to buy in order to put your house on the market for someone else to buy it. And so if there isn't a little bit of slack, a little bit of capacity there, things tend to grind to a halt. We saw that especially coming out of the financial crisis when there wasn't a lot of new construction, there wasn't a lot of movement taking place as people had kind of entrenched. Yeah, maybe a little better to your point, Joel, but certainly some challenges remain.
It also could mean that those consumers who might otherwise be moving to bigger homes have more money to spend and will be spending it on Christmas gifts, et cetera, et cetera. So consumer spending's pretty decent, and these leading indicators have been pretty negative now for the past several years, despite the fact that GDP continues to expand. And corporate profits went up last year. They're forecast to go up next year. So some of these figures can be misleading.
And maybe there are longer-term trends that are going on. Maybe people aren't going to be investing as much in housing as they used to. Maybe they're going to be investing in retirement funds.
Or renting.
Yeah. Yep. No, I think those are all very reasonable considerations. And, I think we'll kind of see how the data shakes out, if it's what the leading indicator survey says, or if maybe it reflects a little more optimism that we see from the consumers. With that, we enjoy doing the program. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.